Hello and welcome to this presentation of the paper The Investment Technology of Foreign and Domestic Institutional Investors in an Emerging Market. This is joint work by Ila Patnaik and I, and this is forthcoming in the Journal of International Money and Finance. What's the question? The question that we are trying to pursue is how good is the investment technology of foreign investors when they operate in an emerging market. Now, there are two different worldviews on this. The first is a story rooted in the international finance literature, where we have this idea that foreign investors are not very bright. Okay, foreign investors don't know a lot about what's going on in an emerging market. There is extreme asymmetric information that is manifested in home bias, that is manifested in a variety of pathologies such as sudden stops and capital flow reversals and great capital flow surges and so on. Okay, so this is one view of the world, that there is asymmetric information and foreign investors don't fare so well. Now, when you deal with a big emerging market like India, where there are more than $200 billion invested by foreign investors, where you have people of Indian origin in all financial firms of the world, you start getting a little nervous that is this really a good description of the world? There is another view of the world. The other view of the world runs like this, that domestic financial regulation in an emerging market has huge problems and the domestic investors suffer from all kinds of distortions. They face financial repression, they face pressure to go invest in public sector companies, as has been demonstrated in China, and so on. So while foreign investors have problems, maybe domestic investors are worse. So maybe in a bad financial system, the foreign investors are actually being a useful part of the process of capital allocation. This is the location of our research project, where we try to get a good quality identification on this question. Okay, let me get into the paper now. Our foundation is the CMIE Prowess database, which has a vast amount of information about firms in India. We focus on a 10-year period, 2001 to 2011, and there is a quarterly disclosure about the ownership structure of all Indian companies. And the two most interesting variables that we focus on are the foreign institutional ownership and the domestic institutional ownership. Now, the striking fact in this data set is that very few firms get any institutional investment. As an example, in 2011, while there are 3,000 odd firms, there are only 700 firms that have some non-trivial FII investment, and there are only 900 firms that have some non-trivial DII investment. Now, this is not new. We know this all over the world. We know that there is home bias. We know that foreigners invest in only some companies. We know that institutional investors shun many companies. But in this, we see an quasi-experimental opportunity, because there are 700 or 900 firms that have got some kind of special treatment, whereas there are thousands who have not. And that offers us an opportunity to study investment technology. Now, by way of description of the data, let us run a pair of Tobit models. Okay, so now you see this data has lots of zeros. So instead of a simple OLS, we're doing a Tobit. The first two columns are about FII investment, and the next two columns are about DII investment. And the picture that you see is that these two are starkly different. The FIIs favor bigger companies. They don't like companies where the promoter has a lot of shares. They are not too concerned about turnover. They disfavor high yield companies. They load up on more domestic beta. They don't like idiosyncratic volatility. They avoid older companies. They avoid public sector companies. They don't like tangible capital, and they are neutral to R&D. Whereas with DIIs, in most areas, we find different things. The DIIs are less concerned about size as compared with the FIIs. The DIIs are much more concerned about liquidity. They don't like to buy into illiquid stocks. They have a different perspective on age. When a company is older, they actually like it. That's the opposite of the FIIs. They load up much more on public sector companies. That's the opposite of the FIIs. They like asset tangibility. That's the opposite of FIIs. And in some sense, they don't like high R&D. Now, these are of course mere regressions. They're pure observational data. We're throwing all the data into one bin. And I don't want to take this stuff too seriously. But it does make the point that there are some sharp differences between FIIs and DIIs. With this background and description of the data, let's get to thinking about some questions and a research strategy. So this Tobit shows us that the FIIs prefer big companies, young companies, private companies, low tangible assets. And there are some good looking features of what the FIIs are doing. For example, they have a nice attitude towards younger companies. For example, they have a nice attitude towards private companies. But does it make this good? How can you claim that it is good for India that young companies get investment? That may be our preconception, but our preconceptions might be wrong. The real test is, how does this work out in the future? If today institutional investor selects a certain company, does that company fare well in the future? So the proof of the pudding lies in viewing a money manager as a forecaster. A good money manager is one who manages to back companies that do well. And while the standard literature on investment technology thinks about stock market returns, we want to go beyond that. We also want to look at economic outcomes, capital, labor, output, and productivity. A good manager is one who will be involved in firms that grow capital, grow labor, grow output, and grow productivity. Okay? And this immediately takes us to the question of asset allocation versus security selection. As an example, suppose there is a FII who has an investment mandate of only investing in firms that are more than $1 billion. What do you compare him against? What if there is a DII who does not have a comparable investment mandate? Then you are really comparing apples to oranges. The FII is investing in very big companies. The DII is investing in much smaller companies. What is more, the decision about whether you should be investing in $1 billion companies or $1 million companies is not even made by the money manager in most cases. This is ultimately the decision of the ultimate investor. By the time a fund is conceived, it has to take a stand on many of these things. Am I a value investor? Do I care about beta? Do I care about size? Some of these things are determined by the ultimate investors. Now, FIIs behave very differently from domestic institutional investors on their exposure to these asset pricing factors. We have some more detail in the paper. For example, FIIs have high beta portfolios. Now, this confounds our ability to discern capability, because in a business cycle expansion, high beta portfolios will always do well. They will produce more returns. These companies are likely to grow more, and so on. So we should not attribute the performance of those portfolios to the money manager. The financial intermediary, that is the fund manager, should be viewed only on his skill in security selection. Okay, so the investment technology of FIIs and DIIs lies in their skill in security selection and not in their allocation. Okay, so we should be holding fund managers accountable for security selection, but we should not get into their asset allocation, and we should not get confounded by differences in asset allocation. So what's a simple way we could approach this? So suppose we write a regression where there is some outcome on the left hand side. Suppose we look at output growth or productivity growth. And we put FII ownership as a dummy on the right hand side, and we put a bunch of these pharma French factors as controls. If we do this, there are three problems. The first is the problem of match balance. It could be the case that the firms where the FIIs have invested are very different from the firms that FIIs have not invested. And then we are using regression to do linear extrapolation between two different groups of firms. This linear extrapolation is fraught with problems. There is a ample statistics literature which teaches us that these kinds of regressions work badly and don't give us good answers. On top of that, there is a problem of outliers. Firm data is bedeviled by outliers in a variety of measures. If we set up a proper design using matching, so imagine we have one firm where there is some size, beta and book to price, and we match it against another firm where FIIs did not invest, then we get two firms who are alike each other. We are not taking a stand with linear models. We are not doing extrapolation. And it also helps us to mitigate the problems of outliers, because generally when you have one weird firm, it will not find a good partner and it will get dropped from the analysis. Now in this we need some clarity on selection and treatment. Okay, in this project we actually want to study the selection process. The heart and soul of money management is selection. Do FIIs select companies well? Now we could do a propensity score match. So we would identify the selection process of the FII and try to find a partner, but that would be missing the point. Hypothetically, suppose we find in that logit that FIIs select companies that do exporting, and suppose that's actually a very good idea. Then by doing propensity score matching, we might end up with similar firms who also do exporting, and that would be missing the point of the selection process. Now on top of a selection process, there may also be a treatment effect. Maybe once an FII gets into a company, he might exercise governance. Maybe he can make a difference to how the firm works better. So this is not a distinction we wish to pursue in this paper, but we want to say that there is a selection process and a treatment effect that is potentially involved, and we are interested in the overall impact. We want to know if once a FII has gone into a firm, that firm does well. So the way we approach this is we use Mahalanobis distance matching to match on the pharma French asset pricing factors. We will find a firm which FIIs have chosen and match it against a partner which has similar size, book to price, and beta, and that will give us an ability to discern what the FII did as compared to firms that got neither. In the financial intermediation literature, we know that institutional investors are quite different from individual investors. To make sure we are not comparing apples to oranges, we compare foreign institutional investors to domestic institutional investors. So this gives me the full picture of the design. In the data set, we have this 2 by 2 classification where there are some firms that got no DII and there are some firms that got high DII. There are some firms that got low FII, and there are some firms that got high FII. For a moment, let's just focus on understanding FII. The firms that got high FII but did not get DII are an interesting pool. They were selected by FIIs and they were ignored by DIIs. So there is something about them which gets FIIs interested. That's group B. We will treat them as being compared against group A, which is a comparison pool that got neither FII nor DII. Okay, and we will do matching between these two groups so as to ensure there are no systematic differences in size, book to price, and beta. This gives us a balanced and quasi-experimental design. Then we will run a bunch of regressions where some outcome variable will be regressed against the dummy of high FII investment. We will do clustered and heteroscedasticity robust standard errors. Okay, so our strategy is that Prowess gives us thousands and thousands of companies. We hunt in these companies to reconstruct something that looks like an experiment and then do a very simple regression in it. This is the opposite of lots of old style econometrics where we throw thousands of firms into a regression. That regression is fraught with problems and we don't quite conclude what is going on. And this identical strategy we also apply for understanding the DIIs, where we will be comparing group C against group A. We will also do 3 variations of this design. First, instead of treating all firms as equal, we will weight by size. The second is we will have more extreme definitions of what is a firm that is chosen by the FIIs. And in the third case, we will have a 4th asset pricing factor, that is liquidity. So let me take stock where we are. As you can see, there are many problems in constructing a good design for this question. And we have hammered away one after another at these challenges. And if you don't take care of these problems, you will just get the wrong answer. And this is not a simple story of selection and treatment effects. Okay, so the standard rhythm of doing some kind of propensity score model to control for selection effects and then see treatment effects is not the heart of what's going on here. We are actually very curious about selection. If foreign investors know how to see what is a good investment and invest in it, and if after that there are no treatment effects at all, that is also quite interesting. That is what investment technology is all about. So our attempt has been to construct a good design where we are able to get 2 groups of firms who are really alike in their exposure to systematic asset pricing factors, but just differ in this one thing, and that gives us identification. Okay, let me turn to the results. In the paper, we show results at many horizons, 1 year, 2 years, and 3 years. And in the paper, we also look back, which is an interesting way to understand the thinking of how foreign institutional investors and domestic institutional investors work. But the main results of the paper are on a horizon of 3 years, and let's go look at them. Okay, so as I said, we have a baseline result, and then we do 3 different alternative modifications of the methodology so as to be able to judge how robust the answers are. Let me take the first line as an example. The first line is about fixed assets. Okay, so in the baseline result, the fixed assets of the firms that are chosen by FIIs have grown by 23% compared to the firms that did not get either FII or DII investment, and this is very significant statistically. Okay, for a comparison with the DIIs, the coefficient is roughly 0 both economically and statistically. Now let's see how this result varies across the 3 alternative modifications to the methodology. It is broadly similar. So instead of 23%, we have 16%, 27%, 17%, always statistically significant. In the case of DIIs, the decline, there is a decline of 12% with DIIs, which is significant. With the other 2, it is a decline of 8%, a decline of 2%. So what's the picture? The firms where FIIs get invested experience strong fixed asset growth. With the DIIs, it is either 0 or it is a slight decline in fixed assets. Okay, let's look at employment. In none of the results is there statistical significance, other than under the more extreme definition where with DIIs there is a 10% decline in employment over the 3 years after the DIIs come in, and it's statistically significant. But by and large, we would say there's not much going on with employment. Let's look at output, that is sales. The firms that got FII investment had 16% growth of sales with some statistical significance. With DIIs, the coef was 0. When we look elsewhere in the table with the size weights, it is 24%, but in the other 2, it's not statistically significant. So it's always positive, but not that strong with the FIIs. With the DIIs, roughly speaking, there is no impact on sales. So nothing changes on the sales of a company on a horizon of 3 years compared to the control. Then we look at the Cobb-Douglas production function measure of productivity. And with the FIIs, the coefs are minus 0.05, 0.1, minus 0.22, and minus 0.25, but none of them are significant. So it's a bit negative across several methodologies, but none is statistically significant. With the DIIs, the coefs are 8%, 24%, 4%, and 7%, and in 2 out of the 4, there is statistical significance. And this is actually consistent with the results above. So as an example, let's just focus on the baseline result. In the baseline result, the fixed assets for the FII investment companies went up by 23%, but the sales only went up by 16%. This doesn't look very good for productivity. Whereas for the companies with DII investment, there was a 4% decline in fixed assets, there was a 4% decline in employment, and yet there was a 6% rise in sales. So that's adding up to an 8% improvement in productivity, which is statistically significant. When we use manufacturing companies only and implement the Levinson-Petrin productivity measure, with the FIIs, there is no productivity change. With the DIIs, for 2 out of the 4 methodologies, there is a positive productivity change. Finally, we come to stock market returns. Finally, investment technology is about stock market returns. The proof of the pudding lies in getting stock market returns. With the FIIs, over a 3-year horizon, the stock market return is minus 12%, minus 11%, minus 38%, and minus 10%. And 1 out of these, the more extreme definition, is a statistically significant result. So either you want to believe that there is 0 impact, there is 0 selection capability on the part of foreign investors, or it is a bit negative. Whereas with the domestic investors, it is plus 18%, plus 24%, plus 24%, plus 18%. And three of them are strongly statistically significant. So we would say that these results are quite striking, that domestic institutional investors possess an investment technology where they are able to do better than the firms that they get into do better than the firms that got neither FII nor DII. With the FIIs, on a good day, you would say that there is no investment technology, but to some extent, there is evidence that they actually lose money in their investment, and the firms that they get involved with are not so good. So, I would like to conclude by pointing to some key features of what we have done. We have taken a very old idea from finance, which is a separation between asset allocation and security selection. And this has been applied to the question of the investment technology of foreign investors. After controlling for differences in asset allocation, do foreign investors produce good returns for the firms that they've chosen when compared with a suitably chosen control? And we've got a quasi-experimental strategy which gives us a pretty good answer. And the results are quite sharp and striking. Foreign investors do not do a good job. They lose money out of the security selection that they do. And in contrast, the domestic institutional investors do well. Okay, so this is an interesting and striking result that has come out of this paper. Now, there are many further things that can and should be done out of this work. Our methodology is based on very standard public domain databases. All we do is we use the quarterly or annual disclosures about the ownership structure of every firm. This is standard data that is observed everywhere in the world. And this kind of research can be done for many countries. We have released the full source code of this paper, and so other people can also jump off this work. The second big question is, do foreign investors always underperform, or are there some periods, are there some kind of firms where they perform unusually badly? So this requires drilling deeper into this result and asking what else is going on. And the really big question is, why do foreign investors do this? Why do they not just buy index funds? You can buy an index fund which matches your required asset allocation based on French asset pricing factors. So that's a real mystery, and we need to go deeper into the principal agent problems and the perceived uncertainty of investing in emerging markets. Thank you.